Hello, this is Mark with Semantics Research with the Daily Report. So today we had quite of a flat day in most of the session until the FOMC, where the market ripped higher on a rally into close. The Fed stated that there was significant risk and continued to reiterate its hawkish stance to fight inflation and the necessity to maintain the credibility of the Fed. We did see rate hike odds rise a bit on the day in response to that. The Fed did say that interest rates may need to rise to prevent inflation from being entrenched, and even if it is at the risk of slowing the economy. And in my opinion, I think the Fed is way behind the curve, and now they are scrambling to regain this credibility. We are now seeing the U.S. labor market showing significant rise of layoffs and job postings plunging down to 22%. The JOLTS report showed that in May we saw a drop in jobs openings at 427,000, but revised upwards from 11.681 million in April. Despite having a large drop in the labor market, we still have tight labor market conditions, and this number still remains stubbornly high. And there's plenty of vacancies that have not been filled. The U.S. Services PMI printed 52.7 in June, which is up from the flash print of 51.6, but down from May. According to the S&P Global, we saw a drop in the U.S. composite new orders and saw rates of input costs and output prices, inflation remaining sharp in June, but eased a bit due to softer demand. It appears that the consumer is shifting from a discretionary spending to essentials, and this is likely to shrink profit margins, surplus inventory, and increase surplus inventory and less sales, which then leads to downsizing of companies. In other news, the G7 has stated that they are planning to cap Russian oil prices at $40 to $60. This plan is to refuse to provide insurance to any vessel that is transporting Russian oil unless the cargo is sold at an agreed price cap, which I doubt anyone would agree to. Hungary and Belgium has already raised concerns, as well as politicians behind closed doors. By banning insurance and transportation services, it will drive oil to higher prices, as it will likely convince Russia to reduce output in the global markets. There is no incentive for China and India as well to agree to this, and the US and EU leaders must be cautious and must not go through this with this policy or risk driving oil prices higher, which can easily spark a deeper recession then. If you take a look at the U.S. utilization of refinery capacity, U.S. refiners are currently operating at max utilization in the recent weeks, as there are concerns of the hurricane season and heat waves. And there's also concerns of hurricanes and heat waves disrupting production and taking capacity off the market, which would then put upward pressure on oil. So, as you can see, we have many potential headwinds when it comes to oil. We have seen lower gasoline demand, which is now at 8.93 million barrels per day, and drops in crude oil, and this caused a drop in crude oil prices internationally, which led to lower gas prices in recent weeks. But at this point, we are seeing refiners run at full capacity on tilt, trying to take advantage of these high refining margins. If we take a look at the average utilization rate, it is at 95%. With the East Coast and Gulf Coast running at 98%. The operable capacity in the U.S. is now 17.94 million barrels per day, which is comparable to 18.976 million barrels per day 2 years ago. But there's something to note is that as refiners run the utilization rate very high, it raises the risk of sudden outages, as it creates general stress on the units. It wears down processing units faster and requires more intensive cooling of a unit, especially in hotter weather, and any sort of outage can reduce supply and drive prices higher. Also, according to the NOAA, there is a forecast of 14 to 21 named storms, which 6 to can become hurricanes and 3 to 6 big major hurricanes. If these hurricanes were to make landfall, we can see refiners having to shut down production, which can further tighten supply. With the economy and markets used to low interest rates and cheap money, the Fed has a dilemma. Either raise rates aggressively to get ahead of inflation, which could bring systemic risk, as the rate of change in interest rates can throw a wrench in the plans of businesses who adjusted to what they think the rates will be at in the future versus losing credibility and letting the bond market bully the Fed. In that case, they would have to do a steady incremental increase in rates to avoid stepping in thin ice areas of the economy. As we normalize, I don't think we will have a sharp recovery in the markets like we did in the past, with risk capital likely sitting on the sidelines for a longer term. We can start buying, we could start entering into value buys and beat up equities if you're willing to hold through a bottoming process, as many of these quality equities are trading way under intrinsic value. But I would say I think people are not eager to jump into equities, and every rally has been met with skepticism. A question we must ask is the Fed willing to raise into what is clearly a slowdown or even a recession, or will they pull back and pivot? Now, historically speaking, we haven't seen inflation come down meaningfully until the Fed funds rate was higher than the inflation rate. That is due to the Taylor rule, and the Fed did mention the Taylor rule recently during testimony, which raises some concerns. If they did that, then you would probably see risk capital on the sidelines for a while, as it would scare investors having the Fed funds rate quite high above the inflation rate. Another question is, what is the Fed going to do with all the mortgage-backed securities on their balance sheet? Are they going to sell it at a loss or hold into maturity? And the average maturity of these mortgage-backed securities is about 7 years, and depending on what they do, it could impact the mortgage-backed security markets and have downstream impacts into rates. Now, on inflation, there are some ways to tame inflation. It's either that you deal with the supply side, which is one way, which we are probably not going to do, as we're not going to produce more oil due to unfriendly green energy policies, and the supply chain is still wrecked, as we still see congestion in some ports, and as we have uneven reopenings, it's still very shaky. Another way is a fiscal policy where you raise taxes but don't spend money, but as we go into next year, we have a massive deficit, and not to mention California is giving out free gas rebates in forms of checks to quote unquote deal with inflated gas prices, which in turn makes the inflation issue much worse, as it drives the price where you start seeing demand destruction in gas prices much higher. And the third way to deal with inflation is the Fed being a blunt instrument that kills demand. And that seems like the only real way to deal with inflation, as the leaders are not doing what is necessary to fix the issues, and they're continuing to play political theater. So it is only up to the Fed to save the day with killing demand. But if they kill demand, and if we recover later on, the supply side is not fixed, and we will have inflation to come running back hot. Now, we have many in the media claiming that the recession will be very shallow, and that is quite uncertain, as those things are actually quite hard to predict, and it all really depends on the Fed, because if the Fed has a policy error that exacerbates the situation further, then that could potentially push us into a deeper recession if we're not careful. And that is it for today. I want to thank you all for watching. This is Mark with Semantics Research, signing out.